These days, everybody's talking about Tesla's giant back orders for their cars, their full self-driving software, and the Giga Berlin and Texas factories. But one thing that's kind of slipping under the radar, even though it was put out there right in front of us in the Q3 earnings call, is their insurance plans. And I would say if you're Allstate, State Farm, Geico, or any of the other insurance providers in the United States, you better take notice because you're about to be disrupted in a major way. For those of you interested in investing, check out Webull, an amazing platform for buying and selling stocks, and now cryptocurrencies like Bitcoin, Dogecoin, and others. Open an account and get a free stock valued at up to $200, and fund your account and get another free stock valued at up to $1,600. Check out the link in the description and help the channel at the same time. Hey y'all, it's Dr. Know-It-All. So this is Saturday, October 23rd. I was kind of hoping I would be doing a video about my first drive with the 10.3 beta software because I do have a 99 score, but it hasn't come out yet. So I figured I would talk about Tesla's Q3 earnings call and something that just like Zach Kirkhorn, who is the master of coin there, or what would be traditionally called the CFO or the chief financial officer, he put out a whole bunch of information about Tesla's insurance, their metrics, what they're using, how many people have signed up for the full self-driving beta software score, or in other words, how many people are interested in getting the beta, and a lot more information that really nobody has talked about, with the exception of Stephen Mark Ryan at Solving the Money Problem, who actually posted the entire, I think it's about 7-minute thing where Zach Kirkhorn talked about Tesla's insurance and really kind of expounded upon it, and it was really kind of lovely. But anyway, he's the only person I think that's even taken notice at all, and he didn't really go into depth about it. So what I wanted to do in this video was talk a little bit more about some of the facts that Zach Kirkhorn revealed about Tesla's insurance, and also, of course, how that's affecting those of us with the beta safety score. So let's take a listen to some of these clips, and then let's talk about the details.
I'm extremely passionate about our insurance product. We have a terrific team here at Tesla of folks who have been spending a lot of time developing this. They're probably listening to the call, so we're pretty excited so far, Pierre. So, I mean, at the highest level here, we entered the insurance market kind of unintentionally, I would say. Our customers were coming to us complaining that the price of traditional insurance was too high, and it was reducing the affordability of a Tesla. And part of our journey here at Tesla is we want as many people as possible to be able to afford our products. That's extremely important to achieving the mission of the company. And if you look at the price of insurance as a percentage of what somebody's monthly payment is, it's quite high. And we spend extreme amounts of effort in manufacturing to take $5 of BOM cost out here or $10 out somewhere else. If we can get $5, $10, $20, $30 out on a monthly payment, you can calculate what that means in terms of reduction of the price of the car if you finance it. And the leverage of improving insurance cost is huge in terms of affordability. And so that's kind of the context by which we stepped into this. As we started to do more research, essentially the tools by which the insurance is traditionally calculated are optimized based upon the existing data, but the existing data is limited. So there's a focus on things like marital status or age or other attributes like that. Accident history is a good one, et cetera. But what essentially happens here is customers who are low risk and don't actually file many claims end up overpaying on their insurance relative to their cost. That overpayment then goes to riskier customers who are essentially being subsidized. And as we looked at this and we looked at the data, we thought this just doesn't seem like it's fair.
So first of all, let's discuss the fact that Zach said that they did not really intend to get into insurance. They did it by accident. But it's part and parcel of what Tesla is doing. Tesla is really passionate about saving $5 here. In fact, I think Elon Musk actually said, if you can save me a penny, I'll be happy, right? In terms of manufacturing, right? So if you can save a penny on every car, he's gonna give you a pat on the back for that if you're one of the engineers at Tesla. So it's they're looking at tiny fractions of money to try to save people on the cost of the car eventually, as it comes out of the factory. But a major factor in purchasing a car is the cost of insurance. If you purchase a car and you're paying, say, $500 a month for the car, right? You've taken a loan out or something, but then you have to pay $300 a month for insurance. That means that the cost of your car has effectively gone up by 60%. So that's a really big chunk of money. So I think what Zach, he didn't really give specific numbers, but it sounds like rather than dealing with pennies or $5 or $10, you could be looking at things. I have a friend who lives in California, for example, who was paying over double his insurance rate for his Tesla once he got the Tesla insurance. So that's the kind of money we're talking about here. And for him, that was over $150 a month. So we're looking at, $1,500, $1,800 per year in savings. That is a big chunk of money. That's a whole lot more than saving a few pennies on manufacturing for the user. So that's actually really important. So essentially what Zach is talking about here is that Tesla didn't really want to get into the insurance industry. At least they weren't really intending to, but that their customers were saying, look, I purchased this car, it's got all of these safety features, it's great to drive, and I'm paying this much money, but then I'm paying an outrageous amount of money through State Farm or Geico or Allstate or whatever insurance provider it is to insure this because the statistics that they have, and insurance is an actuarial science. It's a statistical science. You look through all the tables, you look at the fact of whether the person is married, you look at their age, you look at their driving history in terms of accidents and tickets and so forth, and that gives you an indication of how likely it is that that person is likely to get into an accident. I've talked about this in videos before. I'll put one up here if you want to see that. But basically, insurance companies don't really care if you get tickets. They don't care if you speed. They don't care if you do a bunch of these things. What they care about is how those things correlate to the likelihood that you'll get into an accident, because that's the point at which they actually have to pay money, right? They don't have to pay. If you get a speeding ticket, it's not like the insurance company is paying money for that. You pay the money for it. So it's like, oh, well. But what does happen is that those speeding tickets, if you get several of those, that increases the likelihood of you getting into an accident, at which point they either have to pay to repair your car or the other person's car or both cars, or even worse, if somebody gets injured in the accident, then they have to pay liability costs, which are very expensive. So all of those things are what they actually care about. But other things like your age and the number of speeding tickets you've had and things like that give them an indication of how likely it is you are to get into an accident. Also, you have to remember, just like with health insurance, any kind of insurance is a subsidy sort of platform. So that means that the good drivers, the ones who are in, let's say, the top 10%, are subsidizing the people at the bottom 20 or 30%. In other words, they're paying way too much for their insurance to subsidize the people at the bottom of this pile because they're paying too little for their insurance. So all of this is sort of the background to Tesla's getting into this, because what they have is they don't have general sort of statistical stuff about your age and your driving history. They actually have day-to-day and drive-to-drive information about your drive. And as everybody who signed up for the beta safety score thing has seen, they can actually tell you there's 5 metrics. There's the collision warnings per 1,000 miles. There's the following too closely, which means less than 1 second behind somebody over 50 miles an hour. There's hard braking, there's hard turning, and there's autopilot disengagement. And they basically have a formula which they've actually revealed to all of us, and I've used it to make a spreadsheet to actually look at my safety score with more detail than just a 99 number. But anyway, what they've got is a correlation between that particular score and how likely it is you are to get into an accident. And they can tell on a generalized basis, right? Kind of a full term, like average of all the drives you've ever taken, but they can also tell on a day-to-day basis. And so they can actually adjust your insurance rates almost on a daily basis. And they can also tell you, part of the deal is that they're revealing this to you. They're saying, here's your safety score. If you want to improve your insurance rates, you better do better on the too close following. That's a hard one to avoid, because it's really hard in a big city to give enough distance without somebody cutting in front of you. But anyway, they tell you that information. They say, hey, you're following too close too often. That's reducing your score. You better improve that to get a better insurance rate. But so what this has done is this has taken an aggregate statistical thing and it's turned it into an individual thing. They're able to look at your individual driving, they're able to give you a score, and they're able to nail down exactly what you should be paying, which means that you're paying less if you're in that top 10 or 20 percentile. And the people at the bottom are likely not to get insured, or they're likely to have very exorbitant insurance rates, because Tesla knows exactly how likely they are to be in an accident.
At Tesla, because our cars are connected, because they are essentially computers on wheels, there's enormous amounts of data that we have available to us to be able to assess the attributes of a driver who's operating that car and whether those attributes correlate with safety. Because we do get a signal when a car has been in an accident. So we've been spending our time looking at hundreds of different variables, and also looking at billions of miles of driving history, and we've been able to fit a model that is able to predict with decent accuracy the probability of collision over a period of time. And the model is not perfect, right? The model is a function of the data that we have available. That data set continues to grow. We continue to experiment with new variables, but we do have a model that works pretty well so far. And from that model, being able to predict frequency of collision, we can then align that against a price curve. And we can have individualized pricing integrated into the car, integrated into the app, integrated into that customer's experience, with a feedback loop back to the customer on how they are driving after every drive, the attributes that they were successful on or unsuccessful on, and the tips of things that they can do to improve their safety. So that's what we've developed.
So in this chunk of the video, you can hear Zach talking about how exactly Tesla is doing this, right? So like I said earlier, what they're doing is they're aggregating all of this data, and also they know when somebody gets into an accident, right? They have information that the airbags have deployed. They obviously have some sort of high G information, right? Like, and then oftentimes I'm sure that the person, contacts Tesla and says, hey, I need repair work done on the car because it got damaged. So they know when the car gets into an accident, so they can then back correlate that with the information about that person's driving record, and they can say, aha, these sort of things have factored into them being more likely to get into this accident. And therefore, what we can do is we can produce a formula. And he says it's imperfect. And all of us who've been driving the full self-driving safety score, beta thing, we know it's imperfect. It's really weird. It credits you for running through a yellow light instead of slowing down and stopping. It, dings you if you stop for a pedestrian who's run out in the street in front of you. So these things are very imperfect. It also dings you if you're on autopilot and you have to disengage because somebody on the highway cuts in front of you, and it's a very dangerous situation. So all of these things are super imperfect, and it's very annoying as a person who uses this product, but it's also important to know that they're working on this. This is a work in progress. He said they don't have all the data, and it will get better. So that's part of the process. But also what's going on here is that they do have something that correlates pretty well, and they've got a pretty good idea about how all of this works. And the formula for all of its faults does work pretty darn well. And they're really doing this all with individualized data. So they've got a massive group of billions of miles of customers driving this, but they can then, sort of correlate all of that information to the probability of an accident, which, like I said, is the only thing an insurance company really cares about. And then they can build a formula out, and they can figure out how likely you as an individual are to getting into an accident based on this safety score formula. And then they can figure out a pricing structure, right? So like if your odds are getting into an accident every 100,000 miles, they're going to jack the rate up a lot, right? To cover that, because it's likely that you'll get into an accident at some point during the period of time that you're insured by Tesla, the next 5 or 10 years or something. But if you're likely to get into an accident every 5 million miles, and they have good evidence that that's the case, they're going to be able to charge you a pretty small amount of money. They do still have to subsidize the people with the lower scores to some extent, but not nearly as much as before. So therefore, they're able to lower your price drastically compared to other insurance companies that don't have this information and simply can't individuate the prices that much. But then Zach reveals some information that's really amazing.
We then included the safety score as a part of the FSD beta enrollment program, where we have almost 150,000 cars currently using the safety score, and I believe the latest data is over 100 million miles of driving. So we've been able to go back and analyze that data, and we've learned two things coming from that. The first is that the probability of collision for a customer using a safety score versus not is 30% lower. It's a pretty big difference. It means that the product is working and customers are responding to it. The second thing that we've looked at is what is the probability of collision based upon actual data as a function of a driver's safety score. And that is aligning with our models. Most notably, if you're in the top tier of safety compared to lower tiers, there's multiple X difference in probability of collision based upon actual data.
All right, so there's a lot to unpack here. Number one, and it actually tails in really nicely with my prediction, I said between 100 and 200,000 people would have signed up for the full self-driving request button, and he says almost 150,000, so it's dead on in the middle of those two numbers. So I feel pretty good about that. It was just an educated guess, but that's pretty cool that I was that close to it. But that's really, really revealing, right? They didn't have 10,000 people request the full self-driving beta. They had 150,000 people request this. And so let's say that they had 100,000 customers in California who've had the insurance. That's the only state you're allowed to get Tesla insurance to this point, except for Texas, which apparently has just come online very, very recently. But anyway, for a long period of time. So let's just say there was 100,000 people who were insured by Tesla. They've had that information for a period of time, but all of a sudden in the last month, they've had another 150,000 people who have been driving and not even, having to be on insurance, but just giving them the exact same information that they were getting from their insurance in California, and they're more spread out geographically. So suddenly Tesla has got way, way, way more information, and they're able to utilize that information, and they've sort of backfilled the whole thing, right? They've analyzed the data. If Tesla is anything, it's a data analytics company, right? That's what AI is these days. It's data search. That's what these guys are doing. They're looking through this, they're crunching these numbers, and they're saying, how well do these factors that I talked about earlier correlate to the likelihood of getting into an accident? But wait, it gets even more interesting. As I talked about in the gamifying episode that I did, Tesla is looking at this and realizing that just using the beta safety score, just having that app on your phone and looking at it, has caused those drivers like us to be in 30% fewer accidents than people who are not using it right now. So that has nothing to do with what your score is or anything. That just has to do with the fact that you've got a little thing on your phone that tells you how you did on your last drive. And apparently people are looking at that and they're saying, well, how did I do on my last drive? And then it's saying, you were following too closely or you turned too hard. And then people are taking corrective action to fix those problems. And as they do that, their score goes up, and therefore they're less likely to get into an accident. So this is an incredible positive feedback loop that's going on. And that is due to Tesla, as I said, essentially gamifying safety. They're making this situation, and again, this thing is far from perfect. It's very annoying that some of the little, weird little things that it has, but it's amazing what it's able to do. And that is really cool that people who are using the product have demonstrably gotten into 30% fewer accidents than those who aren't. That's just incredible. And then the last piece of information he talked about in that clip is he said that those who are in the top tier are multiple X less likely to get into an accident than people in lower tiers. So let's just say that's 90 to 100. That's the top tier. That means that tier is 2 or 3 or 4 times less likely to get into an accident than people in the 80 to 90 range or something. So that alone is incredibly revealing for Tesla, and it's incredibly revealing that they're telling us, the public at large, about this. This is really amazing. And again, this is the kind of thing where Tesla just doesn't care. It was the same thing as showing off the Gigafactory Berlin. I did an episode on that if you're interested. But you can see how Tesla's like, hey, this is how we're working. This is all the stuff that we're doing. Check it out. We don't care because other people, the competition has no way of catching us. They just don't care, right? And they're doing the same thing with insurance. They're saying, this is exactly how we're calculating the insurance. They put the formula online on the website. So I was able to take that and put that on a spreadsheet and use it myself to calculate my own safety score down to the 100th decimal. By the way, 99.23 right now. That's my safety score at the moment. But anyway, they put all this stuff out in the public because they know that nobody can compete because nobody else has the data. Nobody else has the capability to do this. So really pretty amazing. It's a giant middle finger to the rest of the industry, but wow.
So, this is a very new and very exciting frontier for us. I know that was long-winded, but we spent a lot of time on this and we put a lot of thought into it. Specifically with respect to the rollout, the insurance industry in the U.S. is intensely regulated, and it's regulated on a state-by-state level. That means that we require regulatory approvals from each individual department of insurance at each individual state. Texas is the first state that we launched in. I do want to thank the Texas insurance regulators here. You've been great to work with. We have a roadmap of additional states. We will launch the product in those states as we receive regulatory approvals. And our goal is to be in every major market in which we have cars in. We did a soft launch in Texas, was it last week? Yeah. And what we're seeing in initial take rate data is that, if you compare that to what we're seeing in California, we're off to a good start here. So, We're very excited about it. We're excited about individual risk-based pricing. We're excited about the ability for folks to become safer and as a result save money. And it feeds into our priority of a company of building the safest products in the world.
And then as you just heard, the last part that Zach talks about is the rollout and how that's going to go. It's been in California for, I think, a couple of years now. It just started, they said they did a soft launch in Texas and they're getting a good take rate, which is cool. And then I know that New York is the next one on the docket. I would actually expect that Georgia will be relatively soon, assuming the regulatory bodies are, amenable to it, because Georgia is actually one of the states that has the most Teslas in it behind California and New York. In fact, I actually think there are more Teslas in Georgia than there are in New York, but I'm not positive about that. But anyway, so Georgia has a lot of Teslas in it, so I would imagine they will try to press to get that done, and that would be great for me because I pay an awful lot for insurance, and I would love to be able to cut that down. And actually, we're really, really strongly considering getting a Model 3 to go with our Model Y, and if we had Tesla insurance, that would really help us to do that because we could reduce our monthly payouts, right? So if we can reduce by each car by $100 a month or something, just at a rough estimate, that would allow us to afford more car essentially. So that would be really helpful. But anyway, all of that stuff is for the future and we'll just have to see how it goes. So what did I mean with the title of this video and with the beginning of it about disruption? Well, here's the problem. You've got, companies like Geico, like State Farm, like Allstate, etc., that base all of their insurance on the people at the top tier subsidizing the people at the bottom tier. And what you've got is the more people who are, and I think in general, probably people who drive Teslas are probably going to be generally closer to the top tier just because they're paying a lot more money for the car and it's a safer car. It's got a lot of collision warnings and other safety features involved to keep the car from getting into an accident. And of course, if it gets into an accident, there's less chance of the driver and passengers, etc., getting injured in the car. So anyway, it's reduced cost to all of these insurance companies. These are, good drivers. So they're the people at the top who are subsidizing the people at the bottom in general, statistically, right? What happens is as Tesla starts peeling away the best of those, right? Because the people who are likely to go to Tesla are the ones who are in the top tier of the Tesla insurance stuff. So they're going to go like, oh yeah, I definitely want to do this because I'll save $100 a month. Whereas the people who might pay the same or more might stick with another insurance company. So essentially what Tesla is doing is they're peeling off the very top layer of the people who are the best drivers. And those, as we said, are the people who subsidize the people at the bottom of the pile. So what these other insurance companies are going to do is start losing those people. And as Tesla gains market share, right now it's just a few percent in the United States, but if they get to 10 or 15% market share eventually, which could really happen very quickly, and I've talked about that in a lot of videos, but as they start to gain market share very rapidly in the United States, and they can take that top chunk, the top, the icing on the cake in terms of the drivers, and they can take those away from other insurance companies, that creates a massive negative downward pressure on these other companies because they lose the people who are subsidizing the people at the bottom, which means they have to raise their rates overall to make everything work out, which means that people will then be even more likely to go with Tesla if they can, which then of course compounds and the insurance companies have to keep raising their rates and then they go out of business because they don't have the finances to be able to afford this. So this is going to take a while because of course it's only for Teslas right now, but as Tesla gains market share in the US, and they will because EV cars are the future and ICE cars are going away and other manufacturers are not producing enough ICE cars, so Tesla's really in the driver's seat about that. And so it will start to affect the insurance industry and it can create some massive negative price pressure on these other insurance companies, and that could cause them to go out of business or have to restructure or something else. And all of this stuff is also happening, and Tesla told us all of this in their Q3 earnings report, and nobody except Steve and Mark Ryan seemed to even notice this at all. So I thought it was very worthy of bringing this up and just letting you all think about this. It's pretty impressive stuff. I hope you agree with me that it's very cool. Even with the imperfections of the beta safety score thing, I think the fact that I've now got over 20 days of 100s in a row shows that I have learned how to drive better than I used to. And the likelihood that I get in an accident is less, quite frankly. I can see how that's happening. It's annoying to have to turn really slowly and stuff, but I can see how that's actually reducing my likelihood of getting in an accident. So in the meantime, hopefully I will get the beta very soon and I'll be able to release another video, but I wanted to put this out because I thought this was very important for people to think about now. I hope you agree with me. Anyway, I hope you enjoyed this video. If you did, please do like it so other people can find it, because that's how YouTube's statistical algorithm works. And also be sure to subscribe if you want to see more of this. As always, a huge shout out to my patrons on Patreon. Thank you all so much for your support. I really do appreciate it. Had a lot of discussions recently on Discord. I've also been quite busy this last week, so I know I've been a little bit gone on the Discord thing, but I'll be back this weekend in spades, so we'll have a lot more chance to talk. Anyway, if you want to join the club, definitely check out the link in the description. And if you're interested in some awesome merch, check out the link in the description. We've got the Tesla Bot t-shirt, which is super popular these days. Don't mess with Tesla. Lots of other t-shirts, tumblers, mugs, etc. So check out the link in the description and help the channel out. And for those of you interested in investing, check out Webull, an amazing platform for buying and selling stocks, and now cryptocurrencies like Bitcoin, Dogecoin, and others. Open an account and get a free stock valued at up to $200, and fund your account and get another free stock valued at up to $1,600. Check out the link in the description and help the channel at the same time. Thank you. And finally, don't forget we are both Tesla and Amazon affiliates. If you look in the description, you can see how going shopping for a solar roof, a Powerwall, or anything on Amazon helps out the channel. And as always, feel free to ask me questions in the comments or at my email address, which is drknowitallknows@gmail.com. Till next time, bye-bye.